Good morning, I'm Maiki Oreta and you're watching Business 360, where we break down the numbers, connect the dots, and give you the developments and the insights you need to navigate, adapt, and lead. Let's dive right in. The government raises over 507 billion pesos through retail treasury bonds, 17 times above target. A congressional think tank warns that tax revenue may fall short of the 15% of GDP goal in the medium term. And Trump vows to back Ukraine with new defense support against Russia. Let's take a look at how global markets performed overnight. On Wall Street, stocks closed mostly flat Monday as investors awaited corporate earnings from major retailers and the Federal Reserve's Jackson Hole Symposium. Walmart, Home Depot, and Target are set to report this week, providing insights into how U.S. consumers are holding up amid trade tensions and inflation expectations. Markets are also watching the Fed's annual Jackson Hole Conference from August 21st to the 23rd, where Chair Jerome Powell is expected to give fresh guidance on the economic outlook and policy direction.
I think the markets right now are so uneven just because of the anticipation of some of the geopolitical talks that we're having. So right now, President Trump has President Zelensky, and they're meeting with some other European Union leaders based off of President Trump's talking with President Putin last week. And so right now, I think we're just in a wait and hold period, seeing what exactly is going to come of this and to see if we can actually make any progress on the war between Russia and Ukraine.
The Dow Jones Industrial Average slipped nearly 0.1%, while the S&P 500 and the Nasdaq finished little changed. In Europe, markets were mixed. London's FTSE rose 0.2%, Germany's DAX fell 0.2%, and France's CAC 40 lost 0.5%. The government continues to tap the market through retail treasury bonds. It sold 507.16 billion pesos worth of RTBs, far above target as investors chased higher yields. National Treasurer Sharon Almanza said demand was supported by strong fundamentals and by expectations that interest rates will keep easing. She noted that yields rallied lower after the rate-setting auction. Now, the 5-year RTB sale was nearly 17 times the 30 billion peso target, though still below the record 584.86 billion pesos raised in February of 2024. The Bureau of Treasury says that the 425.5 billion pesos came from new borrowings, while the remaining 81.65 billion pesos was raised through a bond exchange. The strong uptake highlights investor confidence in government securities and provides crucial funding flexibility as the Philippines works to manage a record 19 trillion debt load by 2026. Now, the government's tax revenues may fall short of the 15% share of GDP target in the medium term. The Congressional Policy and Budget Research Department, or CPBRD, says this is likely even with new tax measures in place. The Development Budget Coordination Committee, or DBCC, projects national government revenues at 4.52 trillion pesos in 2025 and at 4.98 trillion pesos in 2026. But CPBRD's model shows lower estimates, falling short of DBCC forecasts by as much as 90 billion pesos. The World Bank says a 15% tax to GDP ratio is crucial to sustaining growth and funding essential public services. CPBRD also cites more modest growth assumptions. It warns that recent policy decisions could weigh on revenues. These include the value-added tax refund program for tourists, tax incentives under the Create More law, tariff breaks on U.S. imports, and electric or hybrid vehicles, and lower tariffs on imported rice. The country's insurance industry posted a net income of 28.78 billion pesos as of the second quarter of 2025. Latest data from the Insurance Commission shows that this is up more than 3% from the 27.77 billion pesos a year earlier. The gain came as total premiums reached 242.84 billion pesos, nearly 13% higher than the 214.94 billion pesos reported in the same period last year. The country's current account deficit is expected to widen in the coming years. Fitch Solutions Unit BMI sees the gap averaging 2.8% of gross domestic product over the next 3 years, far above the 0.4% average from 2015 to 2019. The deficit is projected at 3% of GDP this year, before slightly narrowing to 2.8% in 2026, 2.6% in 2027, and 2.3% in 2028. BMI says that the wider gap reflects weaker external demand amid global trade uncertainties. With soaring tariffs and rising costs, the future of the country's billion-peso banana export industry is at stake. Exporters are sounding the alarm, and government officials are scrambling to find solutions. Sujin Kim has the details.
The people in the banana export sectors, they're quite concerned, and they're doing everything, no? And of course, there's the other side of the competitiveness. Other countries are quite aggressive, and the aspect.
Businessmen are growing anxious over the worsening situation in the banana export industry. The Trade Department is now closely monitoring the sector. Trade Secretary Cristina Roque acknowledged the need to strengthen free trade agreements for the Philippines to recover, particularly with Japan, where seasonal tariffs can go as high as 18% during winter.
We've been really actually wanting to fix the banana export, especially because of the FTA. We need to do FTAs. We've been talking to other businessmen in Japan through the foreign trade offices in Japan, so that we can also sell. But of course, for Japan, we really need to get the FTA or the JPEPA going.
Roque said a trade mission will be sent to Osaka, Japan next month to push for lower tariffs and wider market access. President Marcos Jr. has directed officials to find ways to protect the banana industry. His sister, Senator Amy Marcos, earlier urged government agencies to focus on banana production and research to avoid lagging behind globally. PhilExport Chairman George Barcelon noted that exporters face other burdens as well.
I've heard from exporters that one of the costs for us is the logistic cost is quite high. Transporting cost is quite high. So because of that, we lose out being competitive.
While Cavendish is the country's primary export variety, officials said other banana products can also be developed for the global market.
You said pwedeng banana chips, it doesn't have to be the banana itself kung malaki ang tariff talaga doon.
Barcelon also called for greater support and innovation to sustain the industry.
I've shared my thoughts with the Department of Agriculture that we should attract the younger people.
Over 329,000 jobs depend on the banana industry, which generates over 42 billion pesos in wages. Sujin Kim, Bilyonaryo News Channel.
It's been a tale of two markets this year. Local stocks struggling to break out, while bonds have been quietly rallying. Yields have pulled back sharply from last year's highs, driven by expectations of rate cuts and strong demand at recent auctions. But with government borrowing set to climb to fund a record 19 trillion peso debt by 2026, the question is, can this momentum hold? Joining us now is Cristina Ulang, the research head at First Metro Investment Corporation. Hi, Cristina. Good morning, and thanks for being here with us.
Good morning, Maiki.
Okay, good morning. Okay, lots to talk about. Let's get started. First, let's talk about the macro stuff and the market drivers. Q4 is just around the corner. With inflation at multi-year lows, more interest rate cuts expected, and GDP growth expected to pick up from about 5.5% this year to about 6% in 2026. As we wind down 2025 and head into 2026, do you expect the mood, the momentum to shift?
Yeah, very bullish about 2026, and we're projecting like 6% GDP growth. And we view 2025 to be the trough year. And what's really positive for us is our low inflation. Remember the 0.9% inflation for July. And I think that's going to give BSP a lot of flexibility to cut interest rates, maybe more than 50 basis points. 25 this month, and then another 25, and hopefully another 25. Because the top priority now is really GDP growth, because we're coming from like 5.5%, and we should be at 6% next year, on hopes that interest rate expenses is going to be lower, and that there will be more investments, capital expenditures from the corporates, and that our consumer confidence will really improve because of the still good employment numbers and then low inflation.
Yeah,
Fourth quarter will be critical. Yeah, I'm excited about the fourth
Yeah,
quarter.
and seasonally, the fourth quarter is really better. That's when consumption really picks up, and when OFW remittances come in to fund consumer-led growth. Okay, Christina, the bond market has been very lively. How much of that rally is anchored on the low inflation, and how much of it is simply the markets front-running the lower interest rate environment?
Well, risk appetite now is a bit low when it comes to equities. People and investors are a bit hedging against volatility. And so the safest way to do it really is to go to fixed income. And so we're seeing lively trading in the fixed income, a lot of churn, and then some profit taking. And given the fresh issuances of the government, so there's upside, and of course the BSP in the background cutting rates potentially more in the second half. So this is giving fueling the excitement over the fixed income market. And so the latest RTB has been gobbled up like several times oversubscribed.
Yeah, not to mention Q2 earnings have been subdued, so that's not looking great for equities. But I mean, so we have that divergence between stocks and equities. How long do you expect this to last, and what might change that?
Well, I have two things that are really critical. Number one is the sustainability of inflation, which is very encouraging because global commodities prices are low, and then oil prices low, and then all of these geopolitical concerns in the Middle East are easing, given and there are talks about between Ukraine, Zelensky, Mr. Trump, and then Mr. Putin. So hopefully, all of these are contributing to the easing of geopolitical tension, helping to lower global commodity prices, and also the oil prices, very critical. And then second, another factor would be weather, because we're so vulnerable to these weather disturbances. Remember, our storms last year were about 13 to 16 storms in the second half of 2024. So I just hope we continue to have benign weather in the second half. And it's good news that what is expected is bumper harvest, rice. No? That's why we have this temporary ban on rice imports, because we're expecting bumper harvest. So that should continue inflation being on the low side. And I think that's very critical. And the weather, and of course, efficiency of our supply chain. So I think this is going to improve the backdrop for corporate earnings in the second half, and then help us achieve the corporate earnings that we're hoping for this year and next. We're seeing like 8% to 9% corporate earnings, and the first half has been in line with the 9% earnings expectations. It's just that some big names have not shown very good relative to expectations. Some big names, but one outperformer really is GT Capital, like 31% growth to 18 billion pesos. And what is really critical about this is that it's like a microcosm of the economy, kasi there is car in GT Cap, car manufacturing, and then banking. So if you're going to look at the overall result, it reflects the economy, the Philippine economy. And so I am hopeful that we will be seeing a recovery in the second half of this year.
Okay, so, speaking of the economy, let's talk about RTBs. The government just raised over ⁻1 trillion pesos for its latest RTB issuance. That's nearly 17 times oversubscribed. I mean, 17 times above its target, rather. What does this strong demand tell you about investor appetite right now?
Well, investors are really trying to be on the safe side. They're trying to take care of their portfolio. There's a lot of riskiness, externally and internally, a lot of sources of volatility. And so the best way to really hedge and achieve your return would be fixed income. And so we're seeing this a lot of interest also on the part of not only of the part of the institution but also on the part of retail investors. We have all of these channels through which they can invest. We have the GCash, we have the Land Bank, DBP, and then OFW Bank, and then of course the direct, the PH Bond website, and then directly through the BTR. So all of these channels are encouraging our Filipino investors, retails, to participate. And I think this is going to be a continuing thing, tradition, and expanding, of course, our capital markets. And given the CEMEPA, which is there, very supportive of the development of the capital markets. And then eventually, pera hopefully gets off and takes off, given the incentives.
Yeah. Okay. You mentioned retail investors. Let's talk about retail participation that has surged with the RTBs on GCash and other apps. Do you think this is a turning point for financial inclusion in the Philippines, or do you think institutions will still remain dominant? What's your outlook for that in the second half and as we enter 2026?
Well, I see a lot of upside in terms of the fixed income space. First of all, right now, if interest rates are still high, we have the 5-year, the coupon for the RTB 5-year at 6%, doing at 5.9% now, then this is very attractive. Given that interest rates are going to come down, the BSP is going to cut interest rate. The Fed is also cannot hold off forever. They will also cut. And interest rate and interest expenses are going to come down. And your time deposit and your savings deposits won't give you the yield and the return that you want. And so it is important that you are able to lock in at this current rate, 5.9, and then it's going to drop. So from a yield standpoint, you're gaining. Also from a price standpoint, for those that are trading and churning the market, they will see also price improvement. So it's really a very good opportunity now, given the backdrop of dropping interest rates and low inflation. So good opportunity.
Yeah. Speaking of the backdrop, of the economic backdrop, another thing we're all looking at is the Jackson Hole Symposium in Wyoming. Markets are watching for the Fed's decision, specifically what Fed Chair Jerome Powell is going to do. What are your expectations, and how might that shape us here at home?
So the two indicators to look forward to or to watch out for would be U.S. inflation. The latest U.S. inflation is a bit faster. The wholesale prices are like inching up 0.9% month on month above the expectation of like 0.3. So it signifies the although there's a stable inflation in the headline, U.S. headline inflation at 2.7, but still it's far from the neutral rate of 2%. So I think that's giving the Fed incentive to hold off, to be steady, because they are afraid that inflation coming from the U.S. tariffs, higher U.S. tariffs, is going to really give a fallout. It will have a backlash on the economy. So they're trying to be very careful. But eventually, the U.S. economy will have to bear the brunt of the higher import cost. Companies are paying the higher import cost. And so the Fed will eventually try to avert any deeper recession or any deeper slowdown happening in the U.S. Remember, there is a midterm election happening in the U.S. So they have to really spice up the economy. And they cannot hold off like steadying. And Trump is also very impatient with the current Fed chair. And there's going to be a replacement come June 30, 2026. And so there are expectations that that Fed chair might be replaced with a lot more dovish replacement. And I think that's giving us hope that interest rates are going to come down in the U.S., providing very good backdrop for Philippine interest rates also to go down, because the dollar is going to weaken if U.S. interest rates is going to come down. That's going to allow the peso to really hold steady versus the U.S. dollar.
Yeah, if Trump gets his way, there might be a change there on that leadership front, but we shall see. But what they do matters so much to Philippine markets, as for our bond and equity markets, especially as we head into Q4. It's going to shape that. Now, let's talk more about the fiscal outlook and our debt load. The government debt is projected to hit 19 trillion pesos by 2026, pushing the debt to GDP ratio to above 60%. How much of a concern is this for bond investors, Christina, or are falling yields cushioning the risk?
Well, if interest rates are going to come down, then interest expenses of government and the debt burden, in as far as interest payments concerned, is going to come down also. That's going to ease. And I think that's one positive factor. Secondly, if we need to grow in 2026, achieve a growth of 6%, we need to fund our fiscal stimulus. We have heard the president talk about very populist measures, very supportive measures for the masses, social services, economic services. I think he's proposing like 6.7 trillion worth of budget for next year, which is 7% higher than this year. So it's very ambitious, it's very aggressive. That's very good for our growth prospects. But the question is funding. And some people are worried that we may be over borrowing. But I think it's always a relative thing. If you're able to grow the economy 6% by way of borrowing, make a very good use of your resources, borrowed funds, then you will be, I think we're going to be successful in bringing the economy to a re-acceleration path. I think that's the most important thing. But imposing new taxes is not an option because it's going to be contractionary to the economy. We need to grow. We need to be very supportive. And I think borrowing would be one viable source of funding. It's just that we really need to make use of it very judiciously and look at the most impactful way of using the money so that we will achieve a growth of 6% next year. So I think that's very tricky and that's very requires a balancing act.
Yeah.
Really.
We have to use the money efficiently, and the spending needs to translate to productivity gains. So credit rating agencies are watching us very closely, with growth expected to pick up, inflation expected to stay low. Given this trajectory, are we on track for a credit rating upgrade?
I think really this is going to be testing period for the fiscal managers because it's really hard to grow the economy and then look for funding and at the same time manage your debt. So the achievement, the focus would be combination of debt sustainability and fiscal sustainability. And we know how hard it is. We've seen the Pinoy government, GMA government bring down the debt to GDP from 70% down to 36% of GDP, and now we're seeing it higher again, 60%, 62%, and then under the new definition, it's down to 57%. And so we really need to put resources where they ought to be, and then really develop the local capital markets so we are able to mobilize resources for the funding of the government, to fund this fiscal stimulus that we badly need for next year, which will be complemented by a monetary policy stimulus also. So we have these the combination of all stimulus in order to bring us to 2026. It's just that the weather, I'm worried about the weather. It's always the weather that is very disruptive. Because it's hard to execute when the weather, it affects your consumer confidence. You have the flooding. So it's nice to hear these flood control projects being put in place.
And resources put where they ought to be, and also really developing the capital markets, Christina. Also, I wanted to go back to interest rates. That's just around the corner, end of the month. If the BSP delivers 2 rate cuts this year, that's the expectation for 225 bips cuts. How much further can yields realistically fall from here?
By year end, we're projecting something like for the 10-year, originally at 6%. But now rates are coming down. So I am thinking in terms of the sensitivity, because in sensitivity of the rates versus the rate cutting of the BSP. The rate cutting of the BSP already captures the inflation expectations. And when the BSP cut 25 basis points after this 10-year fresh issuance of the 10-year last April, I noticed that the 10-year rate dropped by 30 basis points from 6.3, 6.27 to 6.0, 6.12, and so there is that sensitivity of like 20 basis points. So maybe if the BSP is gonna cut 2 times by 25 basis points, I'm thinking we may be hitting like 5.8%, 5.75. So we could be in the range of like maybe 5.9 to 5.75 for the 10-year.
Okay.
That's for the 10-year. But for the entire yield curve, we're seeing it like lower. The entire yield curve is gonna come down. But of course, the short end is going to come down more aggressively because it's more sensitive to the
Okay.
So invest in the long end also.
Okay. Beyond bonds, Christina, what's your base case for the peso and for equities as a tail end of this year?
Well, we have heard the BSP forecast that the current account deficit is going to be worse. It's going to be a lot wider, like 3% of GDP. And then the RBOP, our balance of payments, is expected to be like 6 billion, negative 6 billion deficit year end, coming from $600 billion positive. So these are all negative as far as fundamental impact on the peso is concerned. But why is the peso strong, like dipping to 56 and even touching 55? That's only because the dollar is weak. And I think that's our savior. It's the weakness of the US dollar going into 2026 because the Fed might cut to avert a slowdown in the US economy. And if that happens, then the peso is going to be a bit supported at the 56 level, 56, 57. Best case could be close to 56, 55, 55, 80, 55, 75. That's best case. And that's really predicated on expectations of more rate cuts in the US. The reason why the peso is flirting with 58.50, 58.30 is because of the very strong numbers in the US. Strong GDP growth second quarter, like 3% GDP growth US despite the tariffs, and then the Fed chair becoming very hawkish in his statement. So those two factors are supportive of the dollar. But a second quarter of 2026, we don't see that happening anymore because there's going to be a replacement of Powell, maybe a dovish one, and that's going to be supportive of the peso.
Yeah. That said, Christina, just to highlight, what is your year-end target for the peso and equities?
For equities, we're still hoping that the rate cuts are gonna come through, maybe a lot more aggressive than what the market expects to be, like 50, maybe an additional 25. And then if we hear the Fed talk about dovish rhetoric, and then saying that they could be doing more rate cuts, then we can see the PSA moving higher, like to 6,900, 7,000. So that's really predicated on the aggressiveness of the rate cuts here and abroad. And then secondly, if our weather is good second half, and then we're able to see fourth quarter GDP, third quarter GDP growth really rolling up and improving towards at least the 5.7%. Ayan, that's going to be a best case. That's going to bring the PSA to 6,900, 7,900. Earnings growth of like 9%. We're still hopeful 9% because the first half, if you average the 28 companies composing the PSA, it gives you 10%. It's just that some companies have not beaten expectation. That is where the a bit of a risk of is coming from.
Yeah. And last question, Christina, as the government just raised over $500 billion pesos in the latest RTB issuance, are you worried that this might sap up some liquidity in our financial markets?
Not really, because this is part of the program borrowing already. This has been telegraphed to the market. They're going to be like in the first quarter, this is how much they're going to borrow. Second quarter, this is how much they're going to borrow. And there are some maturities, like 800 billion worth of maturities coinciding with the fundraising. So if you're going to compare the 800 with the 500 raised, then you have an excess liquidity of 300 billion. So where is the crowding out? And secondly, the economy is operating at below potential GDP. Our GDP is 6%. We're only at 5.5%. So what does that mean? It means there's no overheating in the economy and inflation is low. So I don't see any evidence of crowding out. The market really is basking with the fact that we have this liquidity to reinvest. And the market is afraid that they cannot reinvest at the same high yield. So this is really the opportunity to lock in the yields because interest rates are gonna come down.
Yeah, use that liquidity to reinvest. It's just about timing. All right, thank you so much, Christina Ulang, the research head of First Metro Investment Corporation.
Thank you, bye.
We're taking a quick break. Please stay with us as we dive deep into the numbers and the narratives that matter most to your bottom line. let's check on how Asian markets are moving this Tuesday morning. Right now, the Nikkei 225 is in the red, down by 0.3%. Hong Kong's Hang Seng Index is down as well, down by 0.4%. Shanghai's Composite going the other way, up by 0.9%. And Singapore's Straits Times Index down sharply in early trade, down by 1%. Here at home, the Philippine Stock Exchange Index started the week on a soft note, pulled down by profit-taking and because of the absence of fresh catalysts. PSE Index slipped 27 points, or 0.4%, to close at 62.89. Turnover was thin, with 747 million shares worth 6.2 billion changing hands. Analysts say the pullback was largely due to profit-taking after last week's rebound. They add that the market remains in a consolidation phase, with investors waiting for clearer signals. Looking ahead, traders are eyeing U.S. economic data this week, including jobless claims and housing starts. Investors are also watching the Bangko Central's next policy meeting at the end of the month for clues on the direction of interest rates. Meanwhile, analysts note liquidity may be tightening after the government raised over 500 billion pesos from its latest retail treasury bond issuance. Now, let's take a look at the PSE Index right now. As of 10:36, the main gauge is in the red, lower by about 0.5% to 62.61. The broader all shares index in the red as well, down by 0.3% to 37.30. As for the sub-indices, the financials, industrial, property, and services sectors are in the red, while the holding firms and mining and oil counters are limiting the market's decline. Total volume traded is at 111 million shares, valued at 1.24 billion pesos. Market breadth is positive. However, we've got 69 advancers, 59 decliners, while 52 stocks are unchanged. Taking a look at the currency markets, the peso opens at 57.05 to the greenback, weaker than the previous close of 56.97. Some corporate stories. FINMA Corporation is boosting its capital spending to about 5 billion pesos this year, up from an initial 3.8 billion. The higher budget will fund new projects, including the 21-hectare Saludad Township in Bacolod City, a new Davao terminal for cement unit Phil Cement, and an insulated panels factory of Union Insulated Panel Corporation in Porac, Pampanga. CFO EJ Kwahian-Sen said that the increase reflects projects approved last year. The Del Rosario-led group adds that it remains optimistic about growth despite global uncertainties tied to the U.S. tariffs. Lopez Holdings, chaired by Bilyonaryo Frederico Lopez, reports a 57% jump in net income to 5.34 billion pesos in the first half of 2025, lifted by strong contributions from First Philippine Holdings and ABS-CBN. Consolidated revenues held steady at 84.73 billion pesos as gains in real estate services and merchandise helped offset a 4% drop in electricity sales. Expenses also slipped 1%, driven mainly by lower real estate and service costs. Subsidiary First Philippine Holdings saw profit rise 10% to 8.95 billion pesos, with electricity remaining its biggest income driver. Meanwhile, ABS-CBN narrowed its net loss to 852 million pesos as revenues continued to pick up. Business leaders are challenging Dennis Anthony Uy, founder of Converge ICT, to deliver what no telco has fully achieved, connecting the entire Philippines. But Uy insists that the biggest hurdle isn't technology, it's cost, with internet prices still out of reach for many Filipinos. Sujin Kim has the details.
The country's business leaders have challenged Bilyonaryo Dennis Uy to connect the entire Philippines.
Because it's not new technology. It is already existing. Kaya pag binigyan natin and the government really pursues and really serious about connectivity, we are certainly a force to be reckoned with.
If our chairman here, Dennis, can really be given that opportunity to bring it all, not only in Metro Manila, but also to all the local areas and the rural areas, Philippines would really be one of the progressive country.
Uy responded that Converge is ready to connect Filipinos anytime, saying the problem isn't capacity, but the high cost of internet in the country. Uy pointed to Vietnam as an example, where 90% of households are connected because internet charges do not exceed $10 a month.
70% of our Filipino household, they cannot afford to charge. Entry level, the kit alone is almost 10,000.
The Philippine Chamber of Commerce and Industry emphasized that the gap remains wide when it comes to digitalization in the Philippines.
Many of our small and medium enterprises are still struggling with fundamental digital adaptation challenges. Our public institutions, too, have to keep pace with technology innovation.
Uy stressed that internet prices must be made more affordable, citing Malaysia's model of subsidized community-based rates to ensure connectivity is sustainable. He threw the challenge back to government and to his fellow business leaders.
Free is not the solution. Charge them a subsidized rate. To my fellow business leaders, we have the power and the responsibility to lead this change. Without investing in the people, we cannot sustain any gain in technology.
Beyond infrastructure, Uy emphasized that telcos and other tech companies must also focus on human capital, the workforce that will drive digital transformation. Sujin Kim, Bilyonaryo News Channel.
We're taking a short break. Business 360 will be right back. Welcome back. Deliberations on the proposed 2026 national budget got off to a rocky start yesterday at the House of Representatives. Speaker Martin Romualdez assured the public of transparency in tackling the record 6.793 trillion peso spending plan. Barakbayan Party List Representative Percy Sendanya questioned whether citizens will be allowed to actively participate or be limited to simply observing. Navotas Representative Toby Tiangco, meanwhile, pressed for a copy of the small committee report detailing proposed realignments in the 2025 National Expenditure Program.
Why should it be put under consideration? This is of public record. This is in accordance with our rules.
A simple smartphone can now become a cashless payment terminal. Rizal Commercial Banking Corporation is launching its tap-to-phone payment solution. The technology turns any near-field communication-enabled smartphone into a secure point-of-sale terminal. No traditional card reader required. It can also generate QR codes and electronic receipts, helping MSMEs streamline sales and payment tracking. RCBC President and CEO Reggie Cariaso says that the innovation aims to bring more Filipinos into the formal economy. With just a smartphone, a seller can now accept card payments safely and instantly without the cost or bulk of terminals. On another front, a Senate controversy leads to the resignation of a staff member of Senator Robin Padilla, Nadia Montenegro, after being linked to a report of alleged marijuana use inside the Senate building. This matters because it puts a spotlight on discipline and drug policies in one of the country's most powerful institutions. In her resignation letter, Montenegro, a former actress, denied the allegation, saying she only used a grape-flavored vape. She stressed the decision was made out of respect for the Senate and not an admission of guilt. The issue has prompted senators to call for mandatory random drug testing, with Senate President Chiz Escudero confirming that a new policy is now being finalized. Meanwhile, some senators have voluntarily undergone tests to push for a drug-free Senate.
Para sa ganun, baka maengganyo din ang ating mga kasamahan dahil ang gusto rin po natin magkaroon ng drug-free Senate.
I already told my staff, my COS, na tomorrow magpadala dito ng taga-PDEA and pwedeng mag-witness yung mga taga-media. Lahat, starting from me, hanggang down, hanggang sa janitor, ko, magpapadrug test kami.
In news overseas, European leaders meet with U.S. President Donald Trump in Washington, urging a ceasefire in the Russia-Ukraine war. The heads of Germany, Britain, France, Italy, Finland, and the European Union join Ukrainian President Volodymyr Zelensky, along with the NATO Secretary General, during his trip. Trump has been pressing for a quick end to Europe's deadliest war in 8 decades. But Kiev and its allies fear he could agree to terms favorable to Moscow, especially after his productive meeting with Russia at the Alaskan summit last week. Before meeting with other European leaders, Trump and Zelensky held a one-on-one discussion. The U.S. president assured Kiev that Washington will continue providing defense capabilities. He also floated the idea of a three-way meeting with Russian President Vladimir Putin, Zelensky, and himself. But so far, the Kremlin has not committed.
We supported the idea of the United States, of personally of President Trump, to stop this war, to make a diplomatic way of finishing this war. And we are ready for trilateral, as President said. This is a good signal about trilateral. I think this is very good.
We just spoke to, I was just telling the President, I just spoke to President Putin indirectly, and we're going to have a phone call right after these meetings today. And we may or may not have a trilat. If we don't have a trilat, then the fighting continues. And if we do, we have a good chance. I think if we have a trilat, there's a good chance of maybe ending it. But he's expecting my call when we're finished with this meeting.
Swatch, the Swiss watchmaker, is under fire in China after releasing ads featuring an Asian male model pulling the corner of his eyes in a slanted eye gesture. Angry residents in Shanghai questioned how the campaign cleared approvals, forcing the company to pull the ads and issue a public apology in both Chinese and English. Top fashion influencer said that the apology may limit long-term damage, but warns that the brands must do better when representing Asian models.
They already apologized on a long-term basis. I still think the business is going to pick up because it was not really intentional. At least it was not the intention from the brand. It was just maybe some uncareful decision made by the photographer who didn't really understand China. So again, to repeat, don't try to, I think when they do this campaign, especially when they use Asian models, they should pay this attention, like a fundamental guideline.
This matters because China makes up over a quarter of Swatch Group's sales, a market too big to risk cultural missteps. And that's it for Business 360. I'm Maiki Oreta. Thank you for joining us, and keep it here on BNC, the Bilyonaryo News Channel.